Morning, everyone, and thank you very much for joining me. This is the morning market review. My name is Russell Shaw, Senior Market Specialist at FXCM. And my email address is rshaw@fxcm.com. Today is Monday, the 23rd of May, 2022. I'm just going to bring up our high-risk investment warning. And I was working last week, but my humblest apologies. I actually went away to a very picturesque, beautiful part of South Africa, southern Drakensberg, and I made prior inquiries to make sure that there was Wi-Fi there, and there was. It's just the bandwidth, excuse me, wasn't good enough for webinars, so I apologize. But I managed to get some articles out. It was a really cool place to work, but not so much for webinars. Hey Zanetta, hey Howard, nice to have you on the webinar. Hey Rob, yeah, it was really cool. I enjoyed it. Well, I do want to apologize because the markets were really rampaging last week, weren't they? Here's the market commentaries disclaimer. I'll keep this on screen for a few moments. And here's our references: MarketScope 2.0, CNBC.com, and TradingView. We'll go through the CNBC article first. And I got back on Friday afternoon. I just missed the snow. It's snowing there now. It was really cool. Hey Anna, morning to you. Let's go through the news, just see what's in the headlines. So European markets head for higher open despite fears for global growth. European stock markets are expected to open higher on Monday despite fear over the global economy dominating market sentiment. The higher open expected in Europe comes after regional markets closed higher on Friday after a volatile trading week. Despite higher close, European stocks still logged a negative week, while US stocks fell on Friday, extending losses from earlier in the week and bringing the S&P 500 on the cusp of a bear market. US stock futures rose in overnight trading on Sunday after the Dow Jones Industrial Average fell for its 8th straight day amid a broader market sell-off. Shares in the Asia Pacific region were mixed on Monday as global concerns continue to plague investors. The World Economic Forum kicks off in Davos this week, bringing together political and business leaders from around the world. This year's summit comes after several years of COVID-19 pandemic and amid Russia's invasion of Ukraine, which is expected to feature at the top of the agenda. CNBC will be speaking to a variety of leaders at the forum, with the CEOs of UBS, Edelman, SAP, and Ernst & Young Monday, as well as the chairman of the State Bank of India, the chairman of Credit Suisse, and Swedish finance minister, amongst others. All right, that's the end. I'll just also say I picked up a book that I was reading last week called Red Notice. It's really a good book. It's about Bill Browder. He opened up a fund called Hermitage just as Russia was opening up, and you could buy Russian assets at huge discounts to net asset value. And it's really a really good book called Red Notice. So if anybody wants to read it, highly recommend it. All right. Let's take a look at the Dow to start off. And what we have here is the monthly Dow Jones Industrial, but this over here is the COPAC indicator. So I want to start off there. I want to watch the COPAC very carefully. I am a great believer in the COPAC indicator. Whilst I don't think that it is infallible, I certainly do give a lot of regard to it, especially when we're having these huge sell-offs. Now, what effectively we're looking at here is that we are in what's called value territory. So value territory would be under zero. So clearly we're not there. Now, we have to be careful. It doesn't mean that the stock market can't appreciate. It certainly can. It really depends on what the sentiment is. But in terms of a value, okay, in other words, getting good companies at cheap prices, we're not there yet, okay? The market would have to drop further, according to the COPAC, and I would concede that there's other measures to pick up value. This is obviously a technical measure. You can use fundamental measures such as trailing or forward PE ratios, and those measurements perhaps giving different signals to what the COPAC is giving in. But the idea here is that the COPAC generally gives very good signals at the end of vicious bear markets. So whilst there is, I guess, a definition of a bear market of 20% decline, which the the US markets, I think, besides the Nasdaq, the US markets aren't in bear market. I think the Nasdaq is, but I think we must keep an eye on the COPAC. If you bring up the Depth, which I think we should, we can have a quick look here. I'll just FXCM CFD as the instrument, but they will all be very similar. Let's make sure we've got the zero line in. All right, so a bit closer to the zero, but not quite there yet. And the basic signal with a COPAC is it turns up underwritten. It doesn't cross. So there is a website out there that's when it crosses above zero. That's the signal. That's not the signal. The signal is actually when it turns up below zero. There are sometimes false signals. Here's a false signal. I don't have anything to say about getting out of the market. That's not what the COPAC was designed for. Hey, Katie, good morning. Yeah, definitely. Well, Katie just asked if we can go through oil and Nasdaq. We certainly can. So the idea here is there's not quite sort of value. Again, I want to stress, does not mean that we don't find support and move up from here. But in terms of getting those into sort of those dirt cheap type of scenarios, COPAC says we've still got a while to go. But one area where there is certainly value is actually in China. Okay, so if we bring up the China 50, and if we bring up the zero line here, you can see that we are moving into sort of value territory in China. It's got to turn up though, right? It hasn't stopped falling yet. And so China, in terms of cheap investments, is certainly something that I think is worth considering. There's inherent risks going into China, and one of those would of course be, well, it's generally a managed market. Risk premiums there get skewed. Nevertheless, COPAC is under zero here. So that's just something that's worth keeping an eye on. What we can also do is, well, what about currencies? So the COPAC wasn't really designed for currencies, it's designed for the stock market. But for instance, just put in euro US dollar, which has been absolutely had coming off much higher levels. We're now talking about parity when it comes to euro US dollars. Okay, and you can see if we add a zero here, okay, I would caution sort of just putting full faith in COPAC on a currency, because it wasn't designed for that. But the definitely political risk, I'm assuming Anna's talking about China there, but the risk premiums in China would be heightened for a number of risks, and a number of risks, yeah. So you can see that the COPAC indicator, let's just take a look and see what kind of signals it's given us in the past. So start off going all the way back to 2006. Here's a nice up. Remember, we're looking at a monthly, right? Let's take a look here. All right, it's a bit late, but it does give us a few months there. Let's take a look at the next one. Very similar to our previous one. Okay, that's a few months there. So this is a little bit volatile here. Also, I guess this is a good time to say that you can't rely only on COPAC. I mean, it's an extremely long-term indicator. It looks at we're looking at this on a monthly, but we've gone back to 20 odd years. The idea here is it's just sort of part one of a top-down analysis. Let's take a look at the. All right, so here, this is a bit of a rough ride here because it's mostly sideways before it finally kicks up over here. Okay. And here's something else, just about there. It's this is a little early. It only turns over here. Now, just taking a look at COPAC where we are at the moment. It's still dropping. Okay, so the signal here is has not been pulled. What effectively happened here? It's up below zero. That's part one. Part two is it needs to turn up. Okay, so it's not turning up yet. So I'm not sure if we've botched it here, but euro US dollar certainly does qualify in terms of COPAC as being perhaps value. It's a little bit more complex here, because we're not looking at euro in isolation, right? We're looking at euro to the US dollar. And we're also looking at the various monetary policies, which are far more hawkish on the US side. That's why we're still dropping here, okay? But we'll just keep an eye on this. What I think is quite good about the COPAC is that it may give us sort of reason to pause and ponder whether it's worth to be contrarian. Now, it doesn't say you have to be contrarian. I think that would be naive, but it would give us a pause just to consider, well, maybe because there's so much sort of sentiment on one side, maybe we should be thinking, what about the other side? So I think that so we can certainly think about that. Could we use it to look for individual companies? So are you asking, Anna, specifically if the COPAC can be used for individual companies? I mean, the truth of the matter is it probably could. Just bear in mind that it was designed for a stock market index. So just like I'm cheating, say, with the euro US dollar, we may want to cheat. Let's take a look and say Apple. Oh, okay. She says no. There. What is? Yeah. Okay. Okay. You want something more sort of concrete with individual companies, is that right? Just let me know. I'm just going to bring up the Apple here. All right, and I just not making a suggestion to buy or sell Apple is just the first one that came to my mind. So I just treat this as sort of educational. But let's just take a look at the let's just take a look at sort of the COPAC signals. Here's one. Here's one. This is a nice one. Here's another nice one. Okay, I got you, Anna. I'll show you something really cool. I'll show you something very cool in a moment. Okay. Here's one. Here's one. Here's one. Let's take a look. Here's another nice one. Okay. So as these are times when I may say on a technical basis, Apple represented value. Okay, so we're not quite there yet. This was a sort of pretty close, not quite, but anyway. So perhaps this is something to consider. And it's just asking, how would we go about finding good companies? I'm thinking we might have to do a Friday session on that. something that I was reading last night. I'll show you. It is quite mathematical, and then I'll come back to the analysis. But let me just bring up Microsoft Paint. So, all right, I don't want to get into it too much now, but I think we'll organize a Friday session on it. Something I was looking at last night. So there's different methodologies for valuing companies. Something that I was looking at last night is called residual income. Residual income or economic profit. So just to give you a very sort of overview of what that is. When a company raises capital, it's going to have costs associated with it. So when you're raising debt, there's costs associated. When you're raising equity, there's costs associated with it. And we've seen that before when we do discounted, when we do our time value of money, we call it R. We call it R. R stands for required rate of return. So just go required rate of return. So what we want to take a look at is we want to take a look at a company's return on equity versus its R, okay, to see if there's some sort of economic value there. So maybe we can do something inclusive, not this Friday, perhaps the next Friday around this. And so just to sort of round it off, what you'd look at is you'd look at again net asset value. Okay, you'll take a look at its return on equity versus its R. Okay, and then what we want to do is ultimately see if there's some sort of discount to the price it's at. So maybe I'll arrange it. Maybe not. I think next Friday is non-farm payroll, so we'll do it the week after. Okay, so just if I forget about it, Anna, just shoot me an email. I'll make sure this happens. All right, so that's something we can do. All right, let's just go back to the chart. All right, let's bring up. Let's take a look at Nasdaq and oil here because Katie's asked to see that. So let's just go NX. Right, so here's Nasdaq, Katie. Let's bring up the, and we'll go more granular as well. Let's just bring up our zero line here, and you can see that we kind of getting close to that zero, but we're not there yet. Okay. So there's a zero. Again, if we go back, let's just put in the signals here. So going all the way back to 1991, here's the signal. This leads up to the Nasdaq bubble. Then there's a huge capitulation down. After the capitulation, here's the first signal. This is an incorrect. So here's a false signal, but here's the correct signal. So again, it's not infallible, right? It can lead to. Here's the next signal. There was a really good one, right? This is now after the global financial crisis, and that's really the last time that the Nasdaq showed. That's the last time the that showed. Where do we get R from? Okay. So R. Again, I think we will leave this for a very we'll dedicate a full sort of hour and a half to it, Rob. But the way that R is calculated, okay, is from the simplest way it's calculated is from something called the CAPM model, which stands for a capital asset pricing model. Okay, so now we're getting into sort of hardcore financial maths, but it's actually not too bad. Once we understand this, it's not too bad, but it takes some getting used to. And what we would do here is we would need variables, Rob. So the first thing we'll need a risk-free rate. So generally we can take the 10-year, so we'd need a risk-free rate. Then we're going to need what's called beta, and we can get that off a website. Yahoo Finance has got betas for stocks. Again, we won't get into too much detail here. And then we're going to have to try to figure out what's the equity market premium. Okay, once we've got these, the formula is as follows. So we'll get R, I'll call it R equity equals risk-free plus beta. Okay, that's how we would work it out. And this actually looks so difficult at first glance, but it's actually not too bad if we just we basically need to write down 3 lines. This is where we get risk-free from. This is where we get beta. This is where we get ERP. Once we've got that, we can work out R. So it looks quite scary. It's not that bad. So I think we'll need to do a dedicated session on that. Okay. All right. Let us bring up oil, because Anna's also asking about oil here. Looking at UK oil, she's asked if shale is included in it. I would suggest that the influences of shale certainly would be included in it, particularly in US or in West Texas. However, the thing about oil, specifically, I guess, the fracking and just getting the oil out of the ground is not the issue. And as far as I understand, that's cool. Where the shortage is actually is in the refining, and that refining is where there's not enough capacity to refine the oil. That's my understanding. So yeah, I think that we're discounting all available information, including the lack of refining capability. In this, when we're taking a look at UK oil, yeah, let's make this 0. Take a look here, Katie. Take a look at where was the ideal time to get into oil according to COPAC. Okay, remember it's built primarily around risk markets, but if you go back here, in hindsight, what a terrific signal, wasn't it? Hindsight's always 2020. Here's another great signal here. This over here seems to be a false signal, okay, which is probably attributable to the fact it's not the ideal instrument to be using COPAC with. Here was a good signal as well. Here's a good signal as well. Here's a good signal as well. So it seems to be useful, okay? But of course, the difference between the energy markets and say the risk markets now is that energy is certainly not in value territory, is it, Katie? It's now in what we call growth territory, very different to value. And there's typically a tension between the value side of the market and the growth side of the market. And in this case, energy is a growth instrument. It was value after 2020's lockdown. Now it's definitely gone growth. Now, does that mean that oil is not a instrument to get involved with? Now, Of course not. Growth is a viable part of the market to operate in. It just means we're not at that value stage. And again, what does the economics say about it? And there does seem to be a shortfall in supply compared to demand that supports price. Okay, having said all of that, let's go down to our market scope and start zooming in, right? Let's actually start with oil. We'll come back to this side of the market in a moment. So let's go back to oil here. And Indran asking, could the COPAC be used for the shorter time scale? Indran, I would test it, and I would suggest there's probably better ways to do it. You know, it's in my opinion, it's best for the first part of a top-down analysis. That's what I'm thinking. Okay. All right. Let's take a look at the weekly chart here, and we've got a breakout here on the weekly. This over here is the stochastic. Stochastic is a really good shorter-term indicator, because now we're starting to look at momentum, measurable momentum, right? Now, so Katie, taking a look at the weekly, let's put in some references. Okay, let's put in peak troughs. Let's use this as a reference trough. Let's use this as a reference peak. Okay, once we've got that in, here's your higher trough. Okay, and here's your higher peak. Okay, now I know this is a higher peak because this high here is higher than this high here. So on a strict basis, we've got a high trough, high peak, and on a sort of maybe a classical pattern base, it's breaking out of a some sort of continuation pattern. It's called a flag. So now oil all of a sudden does look interesting. What's going to be important for the oil bulls, of course, is that it needs to turn up and head towards 80. It's already turning up. Now it needs to head towards 80. This is bad news for us generally because it's going to add to stagflation right there if we do get that movement up in oil. So on a weekly chart, this is looking quite good. If we just take so higher trough, higher peak. Last week's candle, a little bit of an uncertain candle because it's a spinning top. However, I think it's worth going down to our daily, and here we are looking at Heiken-Ashis. So I'll just show you. We're looking at Heiken-Ashis, which are trend following. So we've changed from red to blue. In other words, it's looking like we're getting into a blue bullish trend. That's the first indicator, trend following indicator. Second trend following indicators are zones, right? So now with a blue Heiken-Ashi candle, and we're in zone 1 between the upper red, upper blue. That's a strong signal, and it could be a 1, 2, 2, 3, and now we can see if we get this leg up here. Now I don't know if it's going to complete because but I'm going to put a question mark. But this is now a distinct possibility. This would get negated, obviously, if we fall back into zone 2. If we fall back into zone 2, then oil is weakening. But right now, it's looking pretty good on a weekly. It's looking pretty good on a daily. What are the shorter term traders doing? And they are taking it up on quite a gentle slope. So you can see this is a gentle line here. This is not a trend line. I'm just sort of showing you that it's quite shallow. It's not a trend line. But the key here is, of course, can it maintain in the 80 area? Because if it maintains in the longer it stays in the 80 area, the greater the chance of further appreciation. We're not overbought So certainly chance of higher prices. What's perhaps the one thing that we've got to concern ourselves? R2 is obviously looking at a resistance area, but any sort of pullback from here, is probably going to be compelling to longs, given the fundamentals. What's the fundamentals? Short supply, okay, coupled with strong technicals. What's the strong technicals? Uptrend, okay, after a completion of a continuation pattern. Now, I'm not big on patterns, but this, just to show you how dire this can be in terms of stagflation, is we're going to add what's called a measured move to this. Okay, so the measured move is certainly, I wouldn't put my trust in a measured move, but it's just sort of academic. It's telling us if the measured move gets hit, okay, we're getting to oil over $200 per barrel now. Again, I wouldn't make this sort of, I wouldn't take this as gospel. What I would suggest is that it's just telling you that the continuation patterns completed, and that there is now a strong, listen to what I'm going to say, a strong probability. We don't know any, there's no definite, there's a strong probability for higher prices. And I'm not sure if we hit 200. I mean, that would be, I think, really, it's going to put all sorts of pressure on the economy. But I would suggest that 150 is probably doable. And that's also going to exert all sorts of pressure. Stagflationary pressure. I don't have cotton. Sorry, KD. But what we can do is we can look at wheat. Let's just take a look at wheat, and then I was just asking correlation between UK oil and US oil, and I would suggest that correlation is very close to 1. Take a look at that. But let's just bring up wheat here. So the reason I bring up wheat is because I've been using wheat and oil to assess the supply side of the economy. That's where all the damage is really being done. And similarly here, okay, is that we can put in a trough, okay, peak, and you can already see where this is going, right? Once you've got the references in, okay, well, here's the next higher trough, and here's the next higher peak. Now, last week we reached a high before wheat sort of capitulated downwards, but the problem with it is that this is still very much a uptrend. So even some sort of pullback here, if it stops before the previous trough, we could still get upward pressure here in terms of wheat supply, and that's going to be adding to that stagflationary pressure. Look at the stochastic, how it's moving towards this 80. Okay, if it hits at 80 and holds, that's real problems globally. That's real problems globally. Let's just go down to the, take a look here. So we saw the expansion here in wheat. Okay, and so this was starting to expand, not this past Friday, but the Friday before. Add your 1, 2, 2, 3. Okay, 1, 2, 2, 3. Okay, so now is there going to be some sort of support? Are we going to move into the next part of this trend? I don't know, but that's what we got to look for. And the way that we would look for that is we would go down to the hourly chart, and we would see if there's going to be bullish crosses. This is where the timing takes place. So you can see that there's something ominous that's taking place here. On the hourly, it looks like there's going to be some sort of bullish cross here. Now, I don't know, if this goes into a swing. Again, I want to stress, no one knows if this goes into a swing, but the evolution of a swing would be first cross would be the moving averages and stochastic. Either one goes before the other, or they go. But then the second part, and the most dangerous part, is the momentum, which is of course going towards that 80 level. If we see wheat going towards that 80 level, if we see oil, I'll just go to UK oil here. The oil sticking out here, all right? Listen to what the central bankers have to say, because that could cause a panic in the market. That could cause a panic in the market. So the supply side of the markets, to me, are looking very ominous. Okay, looking very ominous. Now, we must talk about the stock market before we end here. We'll try to tie it into that supply side. I just want to bring up correlation coefficient between UK oil and US oil. If we just go through to our indicators, just bring in correlation coefficient. Okay, just put in here US oil. All right, let's just put it in. And I'm pretty sure we're going to get that very close to 1 year, Rob. So let's just take a look. It's besides over here, which I'm not quite sure what happened to, and you can see the correlation here is it's almost 1-for-1 most of the time, isn't it? So a very, very strong correlation. This is a monthly scale. Let's just go down to the weekly. Very strong correlations. Very strong correlations indeed. So the idea here is, you know, the supply side, I think, is looking ominous. Now, what's the big idea about that? Well, I'm looking at all the news, and it's starting to say that there is opportunities, pockets of opportunity in the stock market, and that may be so. Okay, that may be so. The problem is, okay, we can't say that the bottom has been locked in yet. Whilst I think there is value, I think that we are sitting on a very fragile market, sentiment speaking, particularly because of these supply side shocks, which we are seeing look to be manifesting once again. If that is the case, let's go back to, let's use the Dow Jones as our proxy for the stock markets here. You can see on the hourly, it's actually looking pretty good, isn't it? So you can see that the hourly has moved. Here, we've got a nice cross there. Everything looks as if it has found some sort of support. What we need to do is do a proper top-down analysis. Okay, so go through to the weekly chart here, and now it looks scary because on a weekly chart, look where our momentum is. Okay, now let me just be very clear here. If there's one takeaway from today, it's about what I'm about to say. Okay, if you go short, if you short into bullish momentum, okay, you're gonna hurt yourself badly. Okay, similarly, if you go long in weak bearish momentum, same thing. There is huge possibility to hurt yourself very, very badly. You're trying to pick a bottom here. Now, this can be the bottom, but I don't know that. Nobody knows that. Okay, what I can say for sure is that our weekly momentum is looking dangerously bearish. Okay, having said that, all right, any bounce here from my point of view would be suspicious. I would think that given how the stagflationary pressures still seem to be building, well, any bounces are going to have huge bullseyes on them for shorts. Okay, so we want to be very, very cognizant of that. There may be a bottom here. We need more proof. Okay, go through to the daily chart. Okay, the daily chart here, we're still in zone 3 and we've got a red Heikin-Ashi. Okay, if we get into zone 2, step 1 If we get into zone 1, okay, now things seem to be doing okay, but then we take a look at the resistance, okay? And what really needs to give here is the shocks on the supply side, okay? That needs to moderate, and I think that's when things become a lot easier. Stagflation is terrible, okay? Stagflation is, the problem with stagflation is that there's no solution. Okay, there is no policy solution for stagflation. You've got to choose which battle you want to fight with stagflation. Now, let's just go through. Given the weekly, given the week daily, all right, R1 is an area that now becomes increasingly important. If that gets taken out, R2 is the next level to keep an eye on. If you go long over here, I just want to reiterate what you're doing. You're going long in extremely weak momentum. That is not a smart thing to do, in my estimate. What you're effectively trying to do is you're trying to catch the bottom. Sometimes you can do it, but you know, it's trying to catch a. I told you the story when I went into a few years back when there was a quite a popular share in South Africa called FXCM Limited, and I just went into free fall. And I went into a trading room, and the head of the trading desk there said he just tried to catch a falling fridge. He just got smashed because he tried to buy it cheap. He got smashed. So you know, trying to pick the bottoms is inherently dangerous. So just be aware of that. There was something else I wanted to say here that I have. So to just monitor this. We need more. By the way, what would be a positive chart pattern here would be a trend. This would be more positive, something like this. Okay, or if the portfolio managers just buying left, right, and center, you know, then like something that's sort of really sort of a V shape like that, which are rare, but that's what we would need to see. Yeah, that's what he said, try to catch a falling fridge. So again, beware of the over optimism here. Remember, it's not the bear markets that do the damage, it's the bear market rallies. Now, whilst we are low, we've seen on the COPAC indicator that we're not in value territory. It doesn't mean that the markets aren't going to go up, but I'd like to see more evidence that we're going to go up. I don't want to see articles on sort of, you know, notable websites saying, well, this was a good opportunity to buy. Well, that may be, okay, but I need more proof. So that's kind of the start for the week. We'll monitor the bullishness and the bearishness, but at the moment, just the key here is be very careful. I'm not sure that this bear has really finished, and the supply side shocks to me look to be ominous. I want to see some moderation there. If we can get some sort of moderation there, I would feel much more comfortable. And it's saying metals needed for green transition. Yeah, look, so this is what I wanted to say. I beg your pardon. Just one more thing, and then we'll. So the thing, and it is that there's when stagflation hits, it's an economic paradox. You know, the episodes of stagflation are few and far between, thank goodness. But where the correction takes place is not in policy, unfortunately. And we'll look at this maybe tomorrow. Where the correction tends to take place, or where the moderation tends to take place, is in the labor market. And that is exceptionally sad because there is huge pain there. Because we could all get hit by that, right? Because that's where the stagflation sorts itself out in the labor market. We'll look at that tomorrow. All right, guys. with that all said and done, if you need to get hold of me, just send me an email. Otherwise, have a great day ahead, and we shall chat time. Thanks, guys.